Hi, everybody. We're going to do part 2 now of financial statement analysis. So, what I would recommend that you do is maybe pull up the PowerPoint or get your book out, and I will kind of do this as if I were in person with you, lecturing on some major parts that I really want to add my own voice and emphasis on so that you can understand. Okay, so we're going to jump right to some of the ratios that we didn't cover in part 1. So what I want to talk about first are asset management ratios. And the first one we're going to talk about is asset turnover. And these ratios will tell you how well assets are being used to generate revenue, which is income, and generate profit, which is net income. Okay, so the first one we'll talk about is asset turnover. And this ratio represents the efficiency of assets in order to generate sales revenue. So when we talk about asset turnover, not asset, we're going to look at net sales. So we jump to the income statement. We look all the way at the top for our net sales, and we divide that by total assets. And that's going to tell us our asset turnover, how many sales we're turning over with the assets that we own. We're also going to look at inventory turnover. So inventory turnover ratio is the cost of goods sold divided by the average ending inventory. There's another one, average collection period. This one looks at average accounts receivable, and accounts receivable can be found on the balance sheet, and this is divided by average daily net credit sales. When we talk about the financial structure or the capitalization ratio, your financial structure, right? If you can picture, structure is like you see a building, right? And how is that building built? Right? So the financial structure is which financial tools are we using to build our business? And as we said before, there's really only two ways to buy things, right? And to build a business. You can do it with debt or you can do it with equity. Debt is the word that that kind of means liabilities, and we find our liabilities on the balance sheet. And equity means what the owners of the business own. So how much of their own personal money they have in the business. So what is their equity? Those are the two ways, right? Remember that car example I gave you. If you want to buy an asset of a car and the car costs $10,000, you have two ways to do it. You could take a loan for $10,000. You could write a check for $10,000, right? So if you took a loan for $10,000, you'd have the structure of that car was purchased 100% with debt. If you wrote a check out of your personal savings account for $10,000, then the structure of that asset is total equity. You own the entire thing. The third way, and most common, is a combination of debt and equity, okay? So we can look at one financial ratio called the debt equity ratio. And this ratio will measure the relationship between debt and equity. And you probably know this for yourself, and it's true in business. You don't want to have too much debt in comparison to the equity. That sets you up for an awful lot of risk, right? Especially if sales decline, or it's a bad economic time, then you may not be able to generate enough money to pay off that debt. So you want a financial structure that is a good combination, a healthy combination of these two ways to get assets. So a ratio of 1 indicates that debt and equity funding are equal, right? 1 to 1. You have $1 of debt to $1 of equity. Whereas if you had a ratio of 1 to 5, it indicates that there's higher debt in the business, right? There's $1.50 of debt to every $1 of equity. When we look at this ratio, you take your total debt divided by your total equity, and that will give you your debt to equity ratio. Sometimes students tell me this is the only one that they really have any familiarity with, because sometimes when you go to get a mortgage or something like that, right, they'll want to know your debt to income ratio. Right? That's something that you hear. So this is a little different, debt to equity. and this will reveal your financial structure or capital structure. Then we have the debt to total assets ratio. This takes your debt divided by your total assets. Your equity ratio is your equity, everything the owners own, divided by your total assets. And then you have the times interest earned, which is your earnings before interest and tax. So the money that you held before you pay interest and tax divided by interest. There's also a section in the book on market test ratios. In market test ratios, we look at the market's perception of the company. So for example, they talk about the price to earnings ratio. In price to earnings, the higher the ratio, the higher the perceived quality of the earnings by the share market. So earnings per share, that ratio is your net profit found on the income statement after tax divided by your number of issued ordinary shares. Okay, so now we're talking shares of a company, right? And if we're issuing shares, that's the equity part, right? So we can also find these on the balance sheet. Another market test ratio is dividends per share. This takes dividends paid out to stockholders divided by the number of issued ordinary shares. Dividends payout ratio, dividends per share divided by earnings per share. And then the price earnings ratio is the market price per share divided by earnings per share. Let's talk for a little bit about the horizontal analysis or the trend analysis. Okay, this is a line by line item analysis, and all the items are expressed as a percentage of the base year. Okay, the base year we're looking at. So if we want to know, have sales increased from 2020 to 2023, our base year would be 2020. Okay, so your book gives an example. A line item could look at an increase in sales over a period of 5 years to identify what the growth in sales have been over this time period. When you're talking about a vertical analysis or a common size analysis, all items here are expressed as a percentage of a common base item, okay? So if you're looking at financial performance, then sales is the base. If you're looking at the financial position, then total assets is the base, okay? All right, let's get into, your book gives an example of looking at Walker Ltd's financial statements, okay? So it says here that an investor is considering purchasing shares in this company. This person will need to look at relevant ratios to see if they should buy these shares, okay? So let's look at some of these forms. If you look at, you'll see they're going to do a horizontal analysis. They're going to compare 2005 to 2006. And the first thing they give us is a balance sheet. I wish that it said balance sheet on here, but I want you to go in and see that you'll know it's the balance sheet because it's going to show you all the current assets, the current liabilities, and then it's going to show the shareholders' funds, total liabilities, and equity. Now, remember I said that the accounting equation says that total assets are equal to liabilities plus shareholders' equity. So if you look at the assets, it'll add up all the assets for 2005, and your total assets are going to equal 1,021,000, right? So 1020.1. And if you look all the way down on this sheet to total liabilities, you'll see that that's the exact same figure. A balance sheet must balance, right? The liabilities and equity have to equal the assets because that's the only way you can buy assets. So you can see the horizontal analysis. They're looking at it here. Assets increased from 2005 to 2006. As did total liabilities and equity. You would expect that because you need liability and equity to buy those assets. Okay. Now we're looking at an income statement for the same time periods, 2025 to 2006, and you'll see total sales for 2005 were $2,240,000,000, and they went up. For 2006, $2.7 million, right? And then you'll see less cost of goods sold, and you'll get to gross profit there. So we had more sales in 2006 and a higher gross profit. And then you can look at all the expenses that were paid, and then your net profit before tax. So our net profit also went up, which is a good thing. And then our net profit after we paid tax went up as well. Statement of cash flows is next, and you can see the side-by-side comparison from 2005 to 2006. Okay, so now let's get into some additional information about this, and then we'll get into a little bit of analysis about this. So it tells us that there were no exact benchmarks for this brand because it's a diversified company. Remember from strategic management, diversified means that it has a presence in many different industries or sectors, right? So it's not just a restaurant or a tractor company or something like that. So it can't quite say this is your benchmark because there's no business that's truly identical or very similar to this. So it's telling us that the following are related to plastic retailing and manufacturing industry. So they're going to look at that one. Benchmark for that industry, the gross profit margin is about 25%. Net profit is 7%. You'll see the inventory turnover, debt to equity ratio, return on assets, and return on equity. Then you'll see they'll do the side by side here, right? So we're looking at the profitability ratios. We're looking at those benchmarks that we're going to kind of try to compare ourselves to, the closest in our industry. So benchmark for gross profit is 25. In 2005, this company did worse than the benchmark, right? And it got a little bit better in 2006. It rose to 22.7. Net profit, the industry norm, is 7%. This company beat it just by a slight margin, 7.1 in 25, but then something happened in 2006 that it went down below the benchmark to 6.1. Return on assets, however, we were doing a little bit better here. The industry benchmark is 12. We were able to see a better return on the assets that we own. We beat the benchmark, 15.6. Then we stayed relatively consistent and went to 15.5 in 2006. Return on equity, the industry norm is 20. We did a really superior job in 2005. We returned 32%. And in 2006, it was dropped a bit to 26%. Asset management, we look at inventory turnover. So the industry benchmark is 6%. We were able to turn inventory 5.8 times and then 5.58 times. Asset turnover, we couldn't find anything, but our asset turnover is 2.2 and 2.53, so we did a little bit better there. Liquidity, when we get into liquidity, right, this is our ability to pay short-term debt. You can see the industry standards or the benchmarks, and then how we did compared to the quick ratio, and then the days payable. The standard is 30 days. In 2006, we were 49.19 days. How we are financially structured compared to other companies. You can see the benchmarks there. The standard benchmark for debt equity is $1 to $1. We were $1.05 to $1. And then we did a little bit better in 2006, so we must have paid off some debt. Our debt was lower than our equity. And times interest, you can see the standard was between 3 and 5. Below 3 is very risky. Above 5 is favorable. We did 10 times, and then we just did a great job in 2006, 39.74 times. So as you look at this, you can read through the report. So the return on equity, it says ROE here. That's the return on equity in 2006 is 26%. The return on equity was decreased by 4%, but the company's ROE, return on equity at 26, remember we said, was still better than that industry average of 20%. The net profit percent and return on assets show a small downward trend. We saw that over a 2-year period. Gross profit margin was slightly unfavorable, but net profit was a little bit more favorable. The horizontal analysis information shows that the sales have increased by 20%. However, our operating costs have increased by 34%. So you can see how much information you're getting in here. It's wonderful that we were able to increase sales, but for some reason our operating costs, our expenses have increased as well. So the recommendation going through here is the strong forecast for the industry. The demand is good. The sales growth in this business are good. We found acceptable ratios as they are quite close to industry average. There's a good cash flow from operating activities, and we saw a favorable return on equity. And remember, this person is looking to be an investor, right, to buy dividends. So that would be something that we would really pay attention to. So therefore, it is recommended that the investor does purchase shares in Walker Limited Company. And that's the end of this video. I hope you found it helpful, and I will see you in the classroom.